It's a milestone on the road to institutional adoption of Bitcoin. So I think it's important. Like, I don't think it drives Bitcoin to $5 million a coin overnight. You know, like some people hype it to be super, super important. I think it's important. It's one of probably 6 or 7 things that are milestones. The significance is big institutional investors want clarity, and they want to know that the asset is a legitimate asset. And so a spot ETF sends a message that it's a legitimate asset.
MicroStrategy Executive Chairman and co-founder Michael Saylor envisions a better climate for Bitcoin, courtesy of BlackRock's and Fidelity's spot Bitcoin ETF applications. According to the renowned business executive, the interest of these Wall Street giants in offering a spot Bitcoin exchange-traded fund will give the cryptocurrency industry something for which it's been clamoring for a long time: the mass influx of institutional investors into the cryptocurrency market. The first decade of cryptocurrency adoption was mainly and massively championed by retail investors, but everyone expected that the following decade will see an influx of big money investors into the space. That didn't begin to occur in 2020, with Saylor's MicroStrategy being the first publicly traded company to hold Bitcoin on its balance sheet. One could argue that the activities of institutional investors continued into 2021 and even early 2022, but were temporarily interrupted by the many macro headwinds that began with Russia's invasion of Ukraine in February 2022. Now, Saylor believes we are about to witness the resumption of those activities with BlackRock ETF application. According to the MicroStrategy Executive Chairman, if even one of these spot Bitcoin ETF gets approved, it would significantly facilitate the influx of big money investors, from pension funds to family offices and other multi-billion-dollar corporations, into the Bitcoin space. During a recent interview with The Block, Saylor also gives his thoughts on allegations about the timing of the ETF applications, just after the U.S. Securities and Exchange Commission, SEC, went after Binance and Coinbase, two of the largest cryptocurrency exchanges. Saylor chalks those allegations up to mere conspiracy theories and explains that the timing of applications is nothing to be suspicious of. We will now bring you clips from the discussion. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos. Also, make sure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and greatly contributes to the channel's growth. Thanks and enjoy the video.
Big institutional investors want clarity, and they want to know that the asset is a legitimate asset. And so a spot ETF sends a message that it's a legitimate asset. The second thing is many of them have to buy securities. They can't buy commodities. So there are trillions and trillions of dollars that are in these institutions, pension funds and institutional investors, where they can buy securities, but they cannot buy commodities. And so they couldn't buy Bitcoin even if they wanted to buy the Bitcoin. It's either for charter reasons, like I raised $10 billion from a pension fund and I promised them I would only invest in securities that trade on national exchanges, or sometimes it's tax reasons. There are tax requirements. So now I start looking for a security, and if I want to buy Bitcoin, I want something that looks like the asset. Technically, one of the interesting things going on right now is if you look year to date at the performance of Bitcoin, it's up 81%. But there's only one ETF. I mean, there's one major ETF I can use to buy it. That's BITO.
Mm-hmm.
Do you know what BITO's performance is year to date? 61% instead of 81%. It's lagging 20%. Okay. So, like, that's a big deal, right?
20%.
Yeah. Instead of 81%, you've got 61% year to date. So they're achieving that coverage via trading on the CME using futures. But apparently you can't really construct.
You have a decay in the futures-based ETF.
Well, there's a story there. The first year it tracked really well, but in the last year to date, it's off 20%. And if you look at year, over 12 months, Bitcoin's up 43%, BITO's up 31%. So it's lagging 12% in the last 12 months. So there's something there. So if you're an institutional investor, What I mean, the spot ETF gives you a perfected way to do it as a security, like theoretically perfected. Look, if an ETF charges you 100 basis points a year, then in theory, that costs you 20% of your performance over the course of the duration of the asset. So it's not ideal, but a 25 to 50 basis point ETF would probably be reasonable. You certainly can't take a 10% a year hit, right, trying to do it with futures. And if you can't hold the asset, the issue with buying the asset is not just the tax issue or the charter issue. Technically, it's harder, but then you got to go through the custody issue. And so I think the spot ETF is an endorsement of the regulators as a legitimate asset, but also it provides an on-ramp where I could go and I could buy $10 million of it in 30 seconds by punching a button. And the alternative would be you could spend 30 months as an institutional investor and not be able to technically buy the same amount of exposure because of all the legal and accounting and governance factors that come into play.
According to recent reports by the Wall Street Journal, the SEC is already working on the spot ETF applications and has issued the first round of calls for more clarity. Last week, the Wall Street Journal reported that the financial regulator needed more clarity on the exchange the asset management firms intend to use for their surveillance sharing agreement, SSA. Such an exchange must be a spot trading Bitcoin platform. But due to the SEC crackdown on the entire cryptocurrency industry, the asset managers intentionally left out the name of the exchange in their initial application. They have since resubmitted the applications, and both BlackRock and Fidelity are using Coinbase, according to reports. The ball is back in the SEC court to decide how to move forward with applications. Let's get back to Michael Saylor's interview as he discusses his views on cryptocurrency regulation and the fate of the industry's tens of thousands of unregistered securities.
If they do register, I'm not sure they'll be called crypto anymore. I think they may be called digital securities. I think if you look at the guidance you're getting from the SEC and the writing on the wall, it's that the crypto industry is going to rationalize down to trading a lot fewer assets. I think that the crypto industry right now has a legitimate path to list assets without an issuer. Okay, and so if you think about the digital assets industry, I think digital assets mean digital currencies, digital commodities, digital securities, digital tokens, digital exchanges. Well, if there's a set of legislation in the U.S. or some country that defined a digital currency, and I'm thinking stablecoin here, right? Digital dollar, or if it defined a digital security, some company, or foundation issued their own token. If it defined a digital token, like either a NFT token or maybe more likely a fungible token, like 100,000 Tom Brady superfan tokens, right? If you define those tokens, you could create a legitimate path to register them and trade them. So what's lacking right now is there is no taxonomy of those assets, and there is no path offered by the regulators. The SEC and the CFTC have not offered a definition or a path. So now you're waiting for Congress. So you're going to need a law. You'll need a law, and the law will need to define the taxonomy. And if the law, by the way, I can see a world, like as a technologist, I can see a world where every security trades 24/7 digitally, like Apple, Google, Microsoft, everything. I can see a world where you have a light security token, which, is not a company, but it's like a crypto token, and it has lighter disclosures. And you make maybe, there's a difference between the disclosures around General Electric, the conglomerate, and the disclosures around Solana, a network token, right? You would think, I could see a world, but we're going to need a political process or maybe a political regime change for that to be put forth. I actually can see the benefit of every celebrity being able to issue their own token, Katy Perry token, Tom Brady token. They could own their own brand, etc. Yeah, I don't think I'd be doing it, but the issue is you need an environment. You need a legitimate path to issue it. Because what happens if Tom Brady issues 10,000 Tom Brady tokens and then issues 100,000 more and dilutes the value of the first 10,000 after representing that he never would? For you to trade these things with the general public, there needs to be a common methodology and an expected set of norms where everybody understands what they're getting into and what risk they're taking, so that they don't say they were cheated after the fact. And the problem is, if there's no defined set of rules, there will always be a person saying, I was misled. And so that's why securities are much more complicated than commodities in that regard, because commodities are not issued by an issuer, so there's nobody to sue. If you bought a bar of silver and it didn't go up in value, you're not suing someone because they degraded the silver and turned it into corn mush. But when you buy the celebrity token and it goes down in value because they flood the market with tokens and they promise they would invite you to a barbecue, but then they stop hosting the barbecues and the token's worthless, you're going to sue them. And the issue will be, what's your legal recourse? So ultimately, the issue right now is there's no legitimate path for someone to issue all these digital assets. And
Michael Saylor is not the only one calling for massive price increases if the spot Bitcoin ETF get approved and encourage institutional investors to invest a percentage of their large portfolios in the leading crypto asset. Popular on-chain analyst Willy Woo recently answered a hypothetical question posed to him on Twitter. Big data research scientist and Bitcoin investor Lynn Brewer asks Woo what would happen if 8 institutions put just 5% of their assets under management into Bitcoin. The firms are Fidelity, BlackRock, JP Morgan Chase, Morgan Stanley, Goldman Sachs, BNY Mellon, Invesco, and Bank of America, all Wall Street giants with over $27 trillion in AUM and increasing interest and activities in the Bitcoin space. Here is Willy Woo's response to the question. What would price do if these guys put 5% of AUM into Bitcoin? My calculations estimate around $310,000 per coin. In a follow-up tweet, Woo adds, it would really depend on whether they deploy in a bearish or bullish phase of the market, but the range would be between $128,000 to $398,000. Right now, it's $310,000. Methodology is via measuring market cap increase versus realized cap increase. What are your thoughts on Michael Saylor's interview and Willy Woo's tweets? Do you think their expectations for a spot Bitcoin ETF will be met if one is approved by the SEC? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.